Ever wondered how corporations raise money? Well, it's not as mysterious as you might think. There are numerous ways corporations amass capital to fund their operations, growth, and expansion. They might borrow from banks, issue shares to the public, or resort to the lesser-known yet equally important debentures. Just like a secret ingredient in a recipe, debentures play a crucial role in the world of corporate finance. Now you might be asking, what exactly are debentures? Simply put, debentures are long-term financial instruments used by companies to raise capital. As we delve into the world of corporate finance, these instruments play a pivotal role. Debentures can be compared to an IOU issued by a corporation, promising to repay a certain amount of money at a future date. But what gives these debentures their value? Unlike secured loans that have assets as collateral, debentures are backed solely by the general creditworthiness and reputation of the issuer. Yes, that's right. Investors place their trust in the company's ability to generate profits and pay back the debt. This makes debentures an unsecured debt instrument, which might sound risky. However, they often come with attractive interest rates to compensate for this risk. From infrastructure development to business expansion, companies use the funds raised through debentures for a multitude of reasons. As you can see, debentures play a significant role in shaping a corporation's financial landscape. So how exactly do debentures work? Stay tuned as we unravel this in the next segment. Corporations issue debentures to investors who then become creditors to the company. You might be wondering, well, how does that work? When a corporation needs to raise capital, it might choose to sell debentures. These are essentially IOUs. The corporation says, "Lend us your money and we promise to pay you back with interest." Investors purchase these debentures, effectively lending their money to the corporation. The corporation agrees to pay back the principal amount, known as the face value, to the holder of the debenture at a predetermined date in the future. This date is known as the maturity date. Until that date, the corporation makes regular interest payments to the debenture holder. These payments are typically made semi-annually. Now let's talk about secured and unsecured debentures. A secured debenture is backed by a specific asset of the company, such as a piece of property or equipment. If the company fails to repay the debenture, the investor has a claim to that asset. On the flip side, an unsecured debenture is not backed by any specific asset. Instead, it's backed by the general creditworthiness and reputation of the issuing corporation. In essence, debentures are a form of debt financing. They allow corporations to borrow money from investors under specific terms and conditions. Now that we understand how debentures work, let's recap the key points. Debentures play a crucial role in the world of corporate finance. Let's briefly summarize what we've learned so far. Debentures are essentially loans that companies issue to raise capital. They provide a fixed rate of interest to the debenture holders, and the principal amount is repaid at the end of a specified period. Now, there are two types of debentures: secured and unsecured. A secured debenture is backed by collateral, meaning that if the company fails to pay back the loan, the debenture holders can claim the assets pledged as security. On the other hand, unsecured debentures don't have any collateral backing them. They're based purely on the creditworthiness and reputation of the issuing company. Investing in debentures comes with its own set of risks and rewards. On the positive side, debentures offer a steady stream of income through interest payments. They're also a safer bet compared to equity shares, as debenture holders are given preference over shareholders when it comes to repaying debts. However, it's not all sunshine and rainbows. The main risk associated with debentures relates to the company's ability to repay the loan. If the company goes bankrupt, there's a chance that debenture holders might not get their money back. This risk is particularly high for unsecured debentures, which don't have any collateral to fall back on. Moreover, while the fixed interest rate might seem appealing, it also means that debenture holders miss out on potential profits if the company does exceptionally well. Unlike shareholders, they don't benefit from the company's success beyond the agreed-upon interest rate. In conclusion, debentures are a valuable tool for both companies looking to raise funds and investors seeking a steady income. However, like any investment, they come with their own set of risks that need to be understood and managed effectively. And there you have it, a simple guide to understanding debentures, a key tool in corporate finance.